Ever wondered where the market stands today and how it might affect your investment decisions? Let's dive into the heart of the matter. The global economy is a complex and ever-evolving entity. It's a vast network of interconnected markets, each with its unique characteristics, challenges, and opportunities. The current market situation is defined by several key indicators, including GDP growth rates, unemployment rates, and inflation rates. Gross domestic product, or GDP, is one of the most crucial indicators of economic health. A high GDP growth rate signifies an expanding economy, which usually bodes well for investments. Currently, nations across the globe are experiencing varying GDP growth rates, with some economies rebounding faster than others in the aftermath of the global pandemic. Unemployment rates also play a significant role in the market outlook. High unemployment can be a sign of an underperforming economy, while low unemployment often indicates a robust and healthy market. As we speak, unemployment rates are showing a downward trend in many parts of the world, reflecting a recovery from the economic disruptions caused by the pandemic. Inflation rates, too, hold a mirror to the economic climate. While moderate inflation is often a sign of a growing economy, high inflation can erode purchasing power and destabilize markets. At present, inflation rates are a mixed bag, with some regions battling inflationary pressures, while others enjoy a stable price environment. But numbers only tell part of the story. Expert opinions from renowned economists and analysts provide valuable insights into the market situation. These experts analyze the data, consider geopolitical events, and forecast future trends, helping investors navigate the complexities of the global economy. In conclusion, the current market situation is a tapestry of diverse economic indicators and expert opinions. It's a dynamic landscape that evolves with every passing moment, shaped by countless factors ranging from political events to technological advancements. Understanding the market situation forms the cornerstone of making informed investment decisions. Stay tuned as we delve deeper into where to invest now in the following segment. So, given the current market situation, where should you put your money? In the realm of investments, there are several avenues to consider. Let's explore some of them. Stocks are a popular choice, offering potentially high returns. Experts suggest investing in companies with strong fundamentals and growth potential. Think about industries that are poised for growth in the next few years. Think renewable energy, healthcare, or technology. Bonds can provide a steady income stream. They're seen as less risky compared to stocks. Government bonds, in particular, are regarded as safe havens, especially during market volatility. Corporate bonds offer higher returns but come with a bit more risk. Real estate is another interesting option. Despite market fluctuations, real estate tends to appreciate over the long term. Some experts suggest diversifying into this asset class, especially if you're looking for a hedge against inflation. And then there's the world of cryptocurrencies. A relatively new player in the investment scene, cryptocurrencies have seen a massive surge in popularity. It's a high-risk, high-reward game. While some experts are bullish about the future of cryptocurrencies, others advise caution due to their volatility. But remember, each of these investment options comes with its own set of risks and rewards. Stocks can offer high returns, but can also be volatile. Bonds provide steady income, but the returns may not be as high. Real estate requires a large initial investment, and the return depends on various factors like location and market conditions. Cryptocurrencies, while potentially lucrative, are highly volatile and unpredictable. So, how do you decide where to invest? It boils down to your financial goals, risk tolerance, and investment horizon. Are you saving for retirement, a new home, or your child's education? How much risk can you tolerate? Is your investment horizon short-term or long-term? In the end, the best investment strategy is one that aligns with your personal financial goals and risk tolerance. Diversification, or spreading your investments across different asset classes, can also be a good way to manage risk. The right investment for you depends on your financial goals, risk tolerance, and investment horizon. What's next for the market? What are the experts saying? That's what we're diving into right now. Let's start with the forecasts of top economists and analysts. First, let's tackle the technology sector. Many experts believe that technology will continue its steady climb upwards. As we become more reliant on digital solutions in every aspect of our lives, Companies that provide these services are expected to thrive. Think about the giants in cloud computing, artificial intelligence, and cybersecurity. They're likely to see more demand and thus more growth. Next, the healthcare sector. As the world continues to grapple with the pandemic, healthcare has been thrust into the limelight. Biotech firms, pharmaceutical companies, and healthcare providers are all predicted to see an uptick in investment. Moreover, the aging population, not just in the United States but globally, suggests a long-term trend towards increased healthcare spending. And finally, the finance sector. With interest rates at historic lows, the finance sector has seen some turbulence. However, as economies recover and interest rates eventually climb, banks and financial institutions could see a boost. Additionally, the rise of fintech is something to keep an eye on. These digital disruptors could reshape the finance landscape, offering potential investment opportunities. Of course, these predictions are not set in stone. Market conditions are fluid and can be influenced by myriad factors: geopolitical events, economic data, even social sentiment. And while it's helpful to know what the experts are predicting, it's crucial to remember that they don't always get it right. That brings us to an important point. These are predictions, not guarantees. They should serve as a guide, a compass to help you navigate the investment landscape. But they should not be the sole determinant of your investment decisions. In the end, the most successful investors are the ones who do their homework. They research, they analyze, and they make informed decisions based on a variety of factors. So, as we look to the future, remember this. Keep in mind these are predictions, not guarantees. Always do your own research before investing. How can you maximize your returns in this market environment? This question has likely been echoing in your mind. Well, let's dive into a few investment strategies that might help. First, let's talk about diversification. This is the practice of spreading your investments across various asset classes, such as stocks, bonds, and commodities. It's like the old saying, don't put all your eggs in one basket. By diversifying, you're minimizing the risk of a single asset dragging down your entire portfolio. Many financial experts advocate for this approach, especially in uncertain market conditions. Next up is dollar cost averaging. This strategy involves consistently investing a fixed amount of money at regular intervals, regardless of the market situation. The idea here is to buy more shares when prices are low and fewer shares when prices are high. Over time, this can potentially lower the average cost per share of your investments. It's a simple, disciplined approach that can help mitigate the effects of market volatility. Then there's long-term investing. This strategy is for those who believe in the power of patience. It involves buying and holding assets for a longer period, usually several years or decades. The principle behind this strategy is that, in the long run, quality investments will yield significant returns despite short-term market fluctuations. Some of the most successful investors, like Warren Buffett, swear by this strategy. Now, it's important to note that no one strategy fits all. The best investment strategy depends on your financial goals, risk tolerance, and investment horizon. Whether you're saving for retirement, a down payment on a house, or your child's college tuition, your investment strategy should be tailored to meet those specific goals. Likewise, your risk tolerance, how much risk you're willing to take on in pursuit of returns, will also play a key role in shaping your investment strategy. If you're risk-averse, you might lean more towards bonds and other safer assets. On the other hand, if you're willing to take on more risk for potentially higher returns, you might choose to invest more in stocks. Remember, the best strategy is one that aligns with your financial goals and risk tolerance. What does the future hold for investing in a changing market landscape? This is a question that piques the curiosity of many. Let's delve into some trends that are likely to shape the future of investing. First off, we have ESG investing, which stands for environmental, social, and governance. This trend has been gaining traction in recent years, and it's not hard to see why. Investors are increasingly aware of the impact of their investments on the world around them, and they're seeking to align their financial goals with their values. As the world becomes more conscious of issues like climate change and social justice, ESG investing is likely to become even more prominent. Some experts predict that ESG investing could become the new norm, replacing traditional investing methods. Next up, we have robo-advisors. These are digital platforms that provide automated, algorithm-driven financial planning services with little to no human supervision. Robo-advisors are revolutionizing the way people invest, making it more accessible and affordable for the average person. Experts are optimistic about the future of robo-advisors, with some predicting that they could manage a significant portion of global wealth in the next decade. Lastly, let's talk about blockchain. This technology underpins cryptocurrencies like Bitcoin, but its potential goes far beyond that. Blockchain could transform the financial industry by making transactions faster, more secure, and more transparent. It could also open up new investment opportunities such as tokenized assets and decentralized finance. While blockchain is still a relatively new and complex technology, experts believe it could have a profound impact on the future of investing. In conclusion, the future of investing is shaping up to be quite exciting. ESG investing, robo-advisors, and blockchain are just a few of the trends that could redefine how we invest. As we move forward, it's important to stay informed about these trends and how they could impact your investment strategy. The future of investing is exciting and full of potential. Stay informed and stay ahead.